All right. Good morning, everybody. It's a light day today. We had some Google news where bad is good. They laid off like 6% of their workforce and the stock went up. We have Netflix with reasonably decent subscriber numbers, but a CEO that's stepping down and being replaced by two insiders. And the market seemed to like that. So Netflix up as well. Not much econ, which is not necessarily a bad thing. 3 days in a row of downside activity. I always hate the idea that we think that there's a reason to bounce just because we've been going down. Market doesn't owe us a bounce. We're not oversold, which I'm going to show you here in a little bit. It doesn't owe us anything, but I think we have the opportunity to see a little bit of a bounce. It's not a dead cat bounce necessarily. There's kind of some qualifications for that to be what we would call it. Both Asia and Europe are, well, Asia closed green. Europe is looking really good so far. The market is still trying to come to terms with this uber hawkish European central bank. The US Fed speakers haven't changed their tone any, so it's not like they're getting a new message around, and maybe they're only just now starting to believe it. It's possible. So while we don't have a whole lot of economic agendas today, we do have a number of speakers, both European speakers and US speakers. With these, they're not always going to be impactful, right? If you can, for an example, Waller is set to speak today. This could be a pre-recorded message where there's no media interaction, no questions afterwards. It doesn't have to be something that's going to be impactful. So usually digging a little deeper and trying to find out what kind of speaking engagement it is will help out a little bit on the expectation of should we anticipate any sort of volatility from it. If it's a live event, they always have the capacity to put their foot in their mouth, right? But if it's a pre-recorded message and it's at some, economic luncheon for Girl Scouts of America or something, probably not going to rock the market. So the comments coming out of Davos about the U.S. debt levels, it's been a mess, and it's been in the red line, crazy concerning levels for a while now, and it doesn't seem to matter to anybody. It's getting to the point where we can't even pay the interest on that debt because the amount of the entire GDP is required just to cover the interest. Well, that doesn't leave much for using that GDP on anything else. I mean, yeah, I don't know. It's the narrative, right? When we are in a topping pattern and we're beginning to roll over, the media will find a narrative to explain why the market is rolling over, even though the rest of us can look at the candle chart and realize that we're in a topping pattern that's rolling over. So they may say, oh, well, we rolled over because of. And yet, if you had never turned on the news at all and was only looking at candles, you would have seen a topping pattern. You would have traded a rollover, having never heard any of the news at all. They just put a narrative to what they see. Retail sales, existing home sales, and the rig count. I worked on those rigs for most of my life. The number of rigs shouldn't change on a week-to-week basis. If they did, it would be significant. Say half the fleet suddenly needed to be taken offline for something like a recall. It's possible. Historically, if you look back, there hasn't been a whole lot of times in history where the rig fleet suddenly increased, 100-fold or got cut in half. So on a day-to-day, week-to-week basis, the rig count should not have too much of an impact. Volume is light again this morning compared to yesterday, right? And it's kind of on par for the week. Yesterday was the standout, and we would attribute that to ECB rate decision and all of the news that was coming in yesterday morning at this time. So I'd say yesterday was the standout. Today is in line with what we've had the rest of the week. Light volume. Price, on the other hand, is very muted and it's very narrow. They call this a narrow IB, initial balance. The logic behind this, or the train of thought, is if you have a very narrow IB, then work that needed to be done today has not been done yet. Say, Joey gets the call and his boss is telling him that she needs X amount of contracts traded. Well, Joey hasn't got it done yet because we haven't moved anywhere. So when there's a very narrow IB, there's work left to be done. The opportunity to make a big move is on the table. And that's another way that you can look at it, right? If you have stored energy that, like a tank of gas, and you haven't yet used that energy, you've still got a full tank, you're ready to go. If you look at the market in the morning and it's made big moves in the overnight hours, it already burned all that fuel. It already made all that movement. Work has already been completed. It becomes a little hard to believe that after really big moves in the pre-market, we're going to continue to make really big moves through the day. And of course, we've seen those kind of days, but more often than not, we end up retracing through those big moves. So really muted IB this morning implies that we have the capacity today to make a big move in either direction with a full tank of gas. We haven't gone anywhere yet. We have a market maker move on deck this morning of 0.5%, on top of the 1.7 for the ADR. So we just round that up to 1.75 and add 0.5% to it. We're looking at 2.25%. That's 2.25% by the end of the day today, from our current location, no less, because we were right at where we opened last night at Globex. All night, all the running around, we are right back where we started, like a hamster on a wheel. So at 2%, 2.25 would set us right up to that white line, pretty much, the cog line, 40.11. Okay. To the downside, $38.40. We haven't had a 3% move yet this year. We had a number of them last year. There's no reason to believe that a 3% move is on deck today. We don't have any econ that big on deck. The market maker move is curious, trying to consider what is on the agenda this morning, giving us a market maker move. None of this. So the one good thing about recognizing that we have such a thing as a market maker move is that it at least gives you a little bit of a heads up. There's some warning signals on the table today. Low volume, which at first I attributed to the idea that, well, we're in a short week and we've had low volume most of the week. But that should have been resolved yesterday and we should be back to normal. So why the low volume this morning? When you add the low volume to the idea that we have a market maker move this morning, something is out there on deck. The market is waiting for information and it's standing on the sidelines waiting for it. And it's starting to price into the volatility. I don't know what it is, but it screams caution. The market maker move here is derived because this front contract series has a higher IV than the back contract series. That's what it comes from. Generally, market maker move is something that we see right before an earnings event, but it also shows up before, investor conference events or new product production, subscriber numbers, Christmas sales, car delivery numbers, events and situations. Well, of course, for the futures, and if you were to go over to SPY and find it there in the indexes, those don't apply. So it has to be something else. It can be anything. If the market deems that there is an immediate reason for concern and starts pricing in a big move, it's reflected here in the implied volatility. That front one gets higher than the back one, and then we end up with a market maker move. So something's on deck, and I don't know what it is. So be careful. Market says we have the capacity to make a big move today. We're going to be focused on an inside day breakout. That's going to be our number one concern. To that end, I like to put things into perspective between the RTH session, the low and the high of yesterday's RTH, which is pretty narrow, honestly. And then all of yesterday, which started at the Globex at 6 o'clock the night before. So those two quadrants. Now, if you wanted to break it down a little more, you could do a half, say from where we opened in the cash session to the low, and where we opened in the cash session to the high. Just get rid of that. So you could do it that way. Have two distinct kind of 50-50 zones. The thing is, between the top of this and the bottom of this is not very wide. So we're going to be looking for an inside day breakout that expands beyond these boundaries and then uses the market maker move applied with the ADR to challenge either this top side 4011 or the downside 3840. Now, we don't have to go anywhere. Just because there's volatility on deck doesn't mean that whatever is feared is actually going to come true. We could just sit here and maintain the range. Since the range is so narrow, I'm not interested in trading that range today. For anybody considering a 0 day today, due to the fact that it's a narrow range, I think you would be better off not trying to do like an iron condor, right? I know it's enticing to put one on, but because of the market maker move and everything else, if you got ran over today, it would hurt. The risk and reward isn't there. So you could butterfly the edges, or run a double diagonal, double calendar, something like that. Or you could go hunting around and find what the market is afraid of this morning. We do have a little bit of an air pocket below us. Looking at the 10-day, 30-minute volume profile, we still don't have a classic shape. But if we break below 3,900, which is yesterday's low, we're going to develop a drop through this shallow zone. Keep in mind that this pivot from Tuesday, January 20, has no support as a value level. So 38.90, if we were to look left and recognize that there's a pivot point way back there, recognize that there's really no volume to help you out. So it's not going to be useful at all, right? Even this level of volume here was only enough to slow it down for a nice little pullback before continuing lower. And it lined up, as a pivot point, look left with this area. Don't count on this one offering you anything. If we break below 3,900, the cog line is at 38.50, and that absolutely would be my target. Then below that, 3,800. 38.11 is the cog line next in line to the downside. But it would be 38.50 and then 3,800. That's what my focus would be. We do have a VPOC at 38.90. We were just looking at that. There's no volume there to assist. We're not going to even expect a first touch bounce counter trend play off of that thing. I think if we move to the downside, we will go right through this VPOC like it isn't even there. Nothing to the upside. If we do get a topside breakout, there's nothing really to give us resistance either. Right? I guess I didn't talk about that, but I was focused on the downside. If we get a topside breakout, say we get above 39.5, that same area that I did mention might give us a little bit of a resistance, but only a first touch. We would expect to hit, maybe pull back a little bit and then run right through it. Just like we did on the way down when we hit it, pulled back a little bit and ran right through it. All right, so I mentioned overbought and oversold, and the idea that we are not overbought or oversold. It may feel like we've moved a lot this week, that we covered a great distance, but we haven't. We're really close to the 10. The 10 is the center. It's the mean. It's the average price. And we're right there. So the market has the capacity to move in either direction today. And we're not even close to being overbought or oversold. So, the idea, and I heard him talking about it this morning on Bloomberg, well, we've been down for 3 days now. So we could easily be down another 4, 5, 6, 7 days. It doesn't owe us a bounce. So don't go long today just because we've fallen for 3 days. That's not good enough. I will point out, just like we were talking before, this thing tends to run in a wave fashion. So once we get to a low and we start to come back, we generally come all the way back. And we can go again, but once we start trending to the upside, we generally make it back to the 10. Same thing on the upside. If we cross above the 10 and we begin to roll over, we most often come back to the 10 again. And we can come back to the 10 and we can bounce and go back up. But very rarely do you see this, right? Where we're headed down to the 10, and before we even get there, it turns around and goes the other way. I mean, it happens, but more often than not, we make it back. And I mention that because when we crossed the 10 to the downside the other day, we've pulled back up. Now, this could just be a shallow pull up before continuing. I'm not saying it has to come back up above the 10, but it's very likely that we're going to make contact with the 10 today and then resolve it from there. The 10 will become a little bit of a magnet when we get to playing around with it too much. It's not support or resistance by any means. Don't trust it. Don't lean on it. But when we get near it like this, we're going to start to gravitate around it, right? React and respond with it. And we'll stay there and consolidate like a happy market, everybody two-sided market, until something happens. Supply changes, demand changes, news, something, then we begin to make a move again. So we've been looking at the daily. We want to take a look at the weekly. We have not yet crossed below on the weekly yet. We're there. I mean, we're right there on it. We're not below it yet. So this market is not oversold. It is not owed a bounce. And we have a Busby. I like Busby. If this Busby follows through, then we will bounce off of that box, and the target is back up to the last high pivot. That's all that it owes us. Now, generally, a trend will start after breaking a range, and then a trend is validated after validating the old resistance as new support, right? So this could become the start of a trend, but it is way too early to say that, and it doesn't owe us that. If the Busby does bounce and we begin moving up towards 4,000, the goal or the destination is back up to the previous pivot. But it has to start that first. So we got to get above 39.5. All right, so this morning, Google laid off 6%, I believe is the number, laid off a lot of people. And bad news is good news. So the market has gapped this morning above the gap. It's kind of funny. Once the market opens, this gap will be resolved. We'll be able to take that off the table because it's done. But we will now have a new gap because we will have closed down here and we'll be opening up there somewhere. What that's going to probably look like is what we had back here. A green day and a gap up, and then another solid green day. Now, it doesn't owe us a run yet, right? We're just talking about this gap. It'll look like this morning. We'll have that gap. If Google gaps up and opens above $95, which, I mean, that's where we're at this morning. We're at 96.6, 96.5, something like that. So we're up there, right around in here. Then the level of resistance that we want to be focused on is $98, and then this high around 99 and some change, and definitely $100. Can't stress it enough. We get any market near $100, that becomes relevant. Old school, but it's relevant. So pay attention when a market gets close to its $100 level. For Google, it's got to get there, right? There's some resistance in the way. 97.77 and 99.53. We would have to get through those. They're not gaps. What's more likely, and it's gonna be the play that I'm looking for, is something more akin to this situation. We gapped up, had a little bit of a run, and down she went. If it had gapped up and stayed there for a few days and then gapped back down, we'd have an island reversal. I don't really want to call this an island reversal, since it really didn't stick. It just gapped up and dumped back down again. One thing that you could do to kind of figure out what Google's going to do is look at who has recently done the same thing, who popped on layoff numbers. Facebook laid off some people a while back, and they popped on those numbers. How long did that pop last? CRM was another one that had a pretty good size move after laying people off. How long did that pop last before it faded again, right? Because it's just a short-term little boost of energy, and then if it doesn't stick, it just fades back out again. Google might hold the move today, but will it hold it for a week? Because if the answer is no, hey, there's a nice trade for a week, maybe two. A nice short, at least back to where we closed yesterday at $93. So I'm going to be watching Google this morning for this kind of a situation where we gap up and we run a little bit more and then just dump and can't keep it. If we don't get that, then it's going to be more like this, where we closed and we opened with a gap up and we run through the whole day. I don't really like this situation where it kept going up, because after gapping that far, I'm not really interested in buying at that point. So if it continues to go up this morning, I'm not playing the long side of Google. Netflix had a pretty decent move, but it dumped right before the close. So if it had made this really nice move from, the 330 level, it'd be a lot higher. Instead, it tanked right before the close and then rallied back up. In the grand scheme of things, this really didn't go anywhere. It was scheduled to move, or it had the potential to move much farther. It's doing pretty good this morning, but it's still within that volatility that it set yesterday. I would be surprised if it manages to get out of that today. Netflix is on the contrarian list for 2023. Long Netflix, long Microsoft, or excuse me, not Microsoft, long Facebook, long Netflix, That was on Seeking Alpha's contrarian list, right? Their thesis is big tech names and mega market cap names, the FANGs, should stay weak through 2023 and that they're not going to be really good buys. But contrary to that point of view, Netflix and Meta or Facebook would be 2 buys. And so far, that's been a fairly reasonable outcome. But the year just started, right? I mean, we haven't gone anywhere yet. And it's not my point of view, it's theirs. I did take long in Netflix. I will be taking a long in Facebook. Because why not? I mean, we can do it with options, and we need to still be long when the market is still falling. It's the way I was taught to trade. You carry shorts in a bull market waiting on the fall because you can't call the tops, and you carry longs in a bear market waiting for the rally because you can't call the bottoms. And if you can do that profitably, then you've got it all figured out. It's still 38.50. I don't see anything else. If we start making that downside move, it's 38.50. And what we're going to be looking for today, if we get below 38.50, we're back in this box. We talked about it yesterday, about how this pivot point from the 10th is kind of our line in the sand. If we break below that and close below it, we're almost destined to go back to 3,800 at that point. But we have to close below it. Yesterday, we didn't even get to the bottom. We didn't get to that level. So if we threaten it today, we punch through it today, it only counts if we close below it today. It'll be a close on the week, and it'll be a close on the day. It will be an inside week breakout. So we need to get below 38.77 and close below it to go to 3,800. If we don't complete that move, then we're still sitting in the middle of nowhere. Don't diddle in the middle. We're not back at these highs, and we're not back at these lows. We're in the middle of a range. You don't want to start a new trade in the middle. So you want to start it when we get back down here or when we get up there. Asia did good in the overnight, and K-Web reflects that. The Hang Seng also reflects that. Due to Netflix and Google, XLC communications sector is doing good this morning. Semiconductors and emerging markets, even airlines getting a little bit of a recovery yesterday. I nailed the call on the reversal on Delta yesterday. Gotta love those V bottoms. Yeah. They're cheap, they're liquid, they're fun. Financials are nowhere yet. We've got positive movement this morning in the monsters of tech, but we don't have finance. And remember, we can do it with one. It works better when we have both. So I tend to use the NY Fang and I use the KRE. KRE yesterday, nice and sideways. We didn't really get much of anything. And NY Fang yesterday, same thing as well. Well, this morning, we've got that move in a lot of those names, but we don't have any in finance yet. We can rally with just NY Fang. We absolutely can. But things work better when we have both. So we want to see those financials come up. And or if we start to dump, we want to make sure that we're dumping on both sides of the fence, finance and tech combined. Lately, I continue to use the VIX 9-day. It's better than nothing, right? The VIX is a 30-day measurement, and it's based on the volume of options traded in the SPX 30 days out. Well, the volume of the options traded 30 days out in the SPX has dropped significantly in the last year. And that is screwing up how the VIX is read and how we can use it. Most of the trading is going on in the front end of the SPX, right? Options with less than a week to expiration, more than 70% on average. When it actually slows down, it's around 50%. And they say, oh, look, it slowed down. Yeah, that doesn't feel like it slowed very much. So the idea is, even though it's better than nothing, it's not perfect. Use VIX 9-day. It's a little bit more responsive. One issue with it, it doesn't move at all in the overnight hours. There's nothing there. So, again, not perfect. If you don't want to use that, use the VIX futures. On Thinkorswim, it will default to the closest front futures contract. If you're on a one of those brokers where you have to put in the series that you want to watch the front ones. So that would be the G's. There's only 5 days left on the Januaries on the F. So no reason, to look at those. I would swap to the G's. Those are the active ones that Thinkorswim is looking at. It'd be the February series. Those trade all night, so you would still have a volatility tool that you could look at in the overnight hours. If we start heading to the downside today in the S&P and we get below 3,900, I really want to see the VIX get above that 22.5. It's going to be a little bit of a benchmark. If we don't get above 22.5 in the VIX, and right now I'm looking at the VIX futures for that number. See what the number, if we don't get above $20 in the VIX 9, it's going to be a little hard to chew on the idea that we're going to continue to sell off below 3,900. On the question of OPEX, is today OPEX? It's a very simple thing to do. It's always the third Friday. Is today the third Friday of the month? Yes. So is it OPEX? Yes. How do we know it's OPEX? It's the third Friday of the month. It's always the third Friday of the month. This is going to be a record-setting January for options expiration, by the way. If you hadn't caught that yet, it's a doozy. The level of options expiring this January beats records for Januaries. It could be. The market maker move that we're seeing today could be attributed to this record-setting level of options volatility for or options volume for January. I don't want to say that it's not that, because I don't know why, right? Like I don't know why there's a market maker move today, but there is one, and that's the main thing. That's one of the reasons I like knowing that such a tool exists. Even if I don't know what's causing it, I know that there is one, and now I can be concerned. If we didn't at least have that, we would be blindsided and not even maybe recognize that a threat was on the table. So even if we don't know what the threat is, we know that we need to proceed with a little bit of caution today and carry an expectation of perhaps an outsized move, which is kind of cool. Knowing that we have an outsized move potentially on the table, we can go in and buy like a way out of the money debit spread today. Spend 10 cents on it. And if you're wrong, you're going to lose your money. There's no fixing it. But it's 10 cents. It's $10. I would not want a whole portfolio full of that junk, right? I don't want to just go out every day buying way out of the money debit trash. But we've got a reason to suspect today that we could make a big move. And if we don't know why there's a market maker move, then I'm sure that there's a ton of people out there who don't even know that there's a market maker move on deck. They're going to get offsides if we do make a big move. They're going to be caught flat-footed. They never saw it coming, blindsided. So if the big move starts to kick off, it could really unravel the market, make a big move. So you throw 10 cents at a market like that, and if nothing happens, you aren't going to make it. You're going to lose your 10 cents. That has a low probability win rate, just like buying a lottery ticket. There's a reason we use that analogy. Lottery tickets are really cheap, and if you're a loser, you just shrug and like, whatever, who cares? It was a couple dollars. But if you win, oh, the payout is awesome. So you might lose 6, 8, 10 times of buying these out of the money debits and just lose and lose and lose. But the one time you hit it, it's a big win. It covers all of your losses and then some. But one, you wouldn't want to do that all the time. You don't want to build a whole portfolio of that trash. And then two, you have to psychologically deal with losing again and again and again and again and again and keep coming back. That's a hard thing to do. If you don't have the stomach or the fortitude to keep coming back to the table and taking another loss, don't start. Because once you start that game, you need the win to cover the losses that you've been taking. So if you start playing that game, don't stop until you get the win that covers your losses. At least get that and then stop. But it is hard to just keep coming back and getting kicked in the face every day. Due to Asia being up this morning, and at the start of all this, due to Europe being up, we did have that expectation that we were going to carry it through into today's market. It really kind of looks like Europe gave it back. So, you know, it might be fading out a little. Let's see what they say over at Finance Juice. All right, so there's a key one right there too. Asian markets are going into their new year, so we're going to lose a lot of market participants. There's some discussion about large asset classes making a turn to the downside and contagion from housing market into commercial real estate. San Francisco is the first thing I think of when it comes to commercial real estate. A little bit of a typo here. They're asking the Biden administration to lift the tariffs on Chinese good imposed during the Trump administration. So, yeah, they a little screw up there. $1 seems to be the last one. If we get through him, and you'll know he's done because it'll quit showing up on Finance Juice, then your afternoon should be free and clear. You just got to get through Waller speaking at this Council on Foreign Relations in New York. All right, so we did not carry the rally that we had in Europe. The hawkish comments turned Europe to the downside. That could bleed over into our market until around lunch. So at 10:30 European market closes, we could take back the market at that point and resume what we were doing from Asia. So 11:30 or 10:30 into 11 o'clock, we have the capacity for a change event. And past 1 o'clock, we're good to go 0 day into the end of the day. Yesterday, I kept pointing out what we were seeing in TNX and TLT in relation to what we were seeing in the S&P was not right. Right, like it's not supposed to do what we were seeing it do yesterday, and it was a large part of me standing aside and not really participating too much, other than little quick nibbles, getting in, getting out, couple points. I don't generally like to play the range noise anyways, but I was still looking for that V bottom reversal that we had talked about, right? Yesterday in the morning briefing, I talked about look for a rally up off of the lows, possibly around 10:30 when Europe closed. And we had that a little later than I had anticipated, but we got it. But things weren't right yesterday. Keep your eye on the TNX, TLT, and crude. If we see crude turn back to the downside this morning and break that range, that'll be insightful, impactful. WTI or Brent. You can use USO, right? Just use the ETF. Makes a great proxy. Otherwise, we're going to look for this to challenge 82 and break through to the upside. Set a whole new leg up in Brent or in crude. only 33% of the NASDAQ is up this morning, 0.5%. It's not enough. And three of those names are Google and Netflix, because 2 Googles and 1 Netflix. So, out of 33 names that are up, those 3 I would just take right off the table. That leaves 30 left. And a lot of them are those China names, those China ADRs, JD, PDD. I don't even see some of the others that I would normally expect. Where's Baidu and Baba and Neo, right? Those usually fit into that ADR China pop list. Still seeing semiconductors in there. MU, NVIDIA, AMD, Amazon, Apple. So we got our big name, mega market cap names, the FANGs, Microsoft. Interesting that Costco's in there, because I was just evaluating that chart with somebody yesterday. It's up this morning for what? No reason. There's nothing there. So with Costco, I'm going to be focused on if it can get outside of yesterday's range, which is 477. We're going to be looking for a gap up and a fall back down. I'm kind of looking around here to see an old example of that. Not really seeing one. So another thing with Costco this morning, that's not really any trading activity, right? There's no volume behind it. They're just prints. Tesla's got the highest pre-market volume, behind that Google, and then Amazon, Apple, and Netflix a long ways down. Then we start getting into Rivian, AMD, PDD, kind of the rest of these mutts. Tesla is up to 130 this morning, 129. That's kind of fading off. $129. So what we want to be watching for here is a red to green. We get this. This is a 100% yesterday's indecision day. From that, here's an indecision day. And then we had this big outsize day. Look for a failure here back to 118. If you're hesitant to go short, let it get below the open of yesterday, 127. If you're still hesitant and you want to scale in or size up, let it break below 125. The target will be the gap close first, so down to 122.5, and then below that, down to the 116. Now, again, there's no reason to. It was an indecision candle yesterday, so there's no trigger to trade here. What you could do is just buy a 116 or a 118 put debit spread really cheap. And if it doesn't make that move, you're out, a couple pennies, 6 or 7 pennies maybe. Or a butterfly or some other very cheap, low cost, because there's really no reason to believe that it's going to dump. When we have that indecision candle, that thing could do anything, right? It doesn't have to go or do anything. But there's a big move on deck across the marketplace. Every name that we've looked at this morning has this market maker move on deck. That's about what I got this morning. One more note that I'll add to all of this: just because there's a big move on deck with the market maker move, it doesn't actually have to go anywhere or do anything. So I'm not saying we're going to make a big move today. I'm just saying that a big move is on deck. We have the capacity to make a big move because the market maker move exists today. We could go into the end of the week right where we're at without having done anything. And if you're looking to avoid the chop today and not get caught up in that narrowed micro focus, let it get outside of yesterday's trading before you do anything, long or short, and let it stick first. Don't get caught in a head fake, right? Say the other day when we had that open and we popped to the upside for 20 minutes before we dumped. And then the next day after that, when we gapped up and we ran up just a little bit more, got into the previous day, and then we dumped. From where we closed yesterday in the SPX, we left this pivot point behind. We could open gapped up, run up, hit our head on yesterday, and dump. So just because we get above yesterday's high a little bit doesn't give us the trigger to go long immediately. Keep in mind that if we do get a big move today and we start the breakout, we could retrace most of that big move from Wednesday. 50% is going to be the target on that, and that's 39.75 for a nice round number. If that's our target, you've got plenty of time, plenty of room. You don't have to try to go long as soon as we break outside of yesterday's high. If we even break out of yesterday's high, right? We could just as easily break out of the low or no breakout at all. My point is, give it a little bit of time. Don't just immediately jump into it because it breaks out. Let it prove itself. Get above that box. Even better, get above the close from Wednesday. That would be where the lower EM is anyways. And that puts us back in the box where we're supposed to be. It's where we close more than 70% of the time. Then try to catch a run. Watch the clock. Make sure it ties in, that we don't do it too late. We're not supposed to break out after 10:05, 10:10 at the worst. So if we run to the upside and we get out of that thing at 10:15, that's a fake breakout. Don't trade it long. Not unless it came with, headlines across the board. Don't trade that breakout. If it happens first thing in the morning, getting there is probably the entire move. So, again, don't trade it long until you got some signals to go with it. For the downside, it'll be the same thing. Yesterday's low will be the trigger. Just because we get outside of yesterday's low, it does not immediately give us the trigger to go short. And that happened back here, where we set a low on the morning and then we revisited that low and then we rallied back out of it. Same thing here. So don't get caught on the head fake. Yeah, to be fair, with the market maker move, catching people off sides is what's going to really galvanize the move, right? So with that in mind, the strat with that stop pop bubblegum machine concept that he talks about would be the catalyst that could continue the move to the upside. The reason that doesn't really apply, though, is because of how big that move is Wednesday. In the strat, they talk about thinking of where the stops would be. Well, the stops would be way up here. We wouldn't be triggering into stops, getting us to go higher and higher and higher, because the stops that we need to trigger are already way high away. So when it comes to could we make an upside move? Yeah, if we catch enough people off sides, we could, and it'd just be like a massive squeeze. But it's the direction we don't think the market's going to go that catches the people off sides that really give it the capacity to continue the run in that direction. We've seen it on days like this, right? Where we just keep going higher and everybody keeps trying to short it. And then they got to puke those shorts and add to the buying and add to the buying and add to the buying. And it just kept squeezing everybody up higher and higher and higher and higher. I don't think it's going to do that. Going higher is not my base case argument. But we don't have to assume direction. All we got to do is let the market pick a direction, get above our pivot points, take the trade. And that's the thing that I tend to focus on more than anything else. When people ask me, you think we're going to go up today? You think we're going to go down today? How far you think we're going to go today? I'm not in the prediction business. I don't have to predict we're going to break up or break down. I can just see it break down and activate the plan that I have if we break down. Or we can see it break to the upside and activate the upside plan for an upside breakout. If then works much better than I think we're gonna. Everybody enjoy your weekend. Be careful, be safe. Remember, we're getting close to FOMC. So adjust your portfolio and keep that front of mind for any swings that you're going to be focused on. We're coming into FOMC. Take a real good look at your portfolio over the next week or so, because February 1 is a Wednesday. We're going to have an FOMC event and we have the capacity for a big move. Don't wait until the last minute and then realize, oh man, I'm carrying a lot of stuff that I might not want to take a gut punch on if this market suddenly makes a 6% move. See y'all next week.